back to the Matrix, and it's the Matrix. You are the Matrix. How's it feel, Neo? And today we got ourselves a banger daily market news and analysis. We are 2 minutes away from the FOMC meeting, I believe. Well, the meeting's already taken place, but from the reaction to that, so we're gonna be live streaming it. Let me just pull up TikTok over here. And we're going to be live streaming all of that for you guys. So let me just pull this up real quick. How's everyone feeling out of 10? Let me know down in the comments down below. Make sure you guys are spamming the like button, hitting the share so other people can spam the like button and hit the share. All right, let's pull this up here. So they have not started the talk just yet. I don't think. We got the AP over here. So nothing yet. I'll keep an eye on it. I usually do Yahoo. That's what I normally do, actually, because they're pretty good. Live on YouTube. I am live on YouTube. Indeed. Indubitably. Should be. Hopefully. Yes. Let's go. Budski. Sup, everyone. Budski. Hey, brother. Yeah, we're live on YouTube. Your boy Ski in the building. Sure am. All right. Are they not live? What the heck? Here we go. All right.
On achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggests that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by 1/4 percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments.
Oh my.
We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Cap. Michael, over. I have
Nick
sold
Timmeros,
the
The Wall Street
topical
Journal.
agenda.
Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook? Or could this unfold along the lines of last year where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
No, we're not cooked. I'm going to let him talk and give you guys my thoughts.
I'm Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again.
Each day that passes, Jam looks more
I would
right.
say we're not going to be
About
able to have the
My
the
man's been
detailed
bearish since
feel
2022.
of
What's he right
things.
about?
But I think
His
if there
recent
were a
2700
significant or material
call
change
top?
in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, you know, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with, you know, the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be, right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we'll expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6
Keep reposting the stream,
tenths,
guys.
and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
with the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And, overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get, the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say, we really can't see, so let's slow down.
As a follow-up, in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or a similar thing. We are, if you listen to the earnings calls or the reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower cost products, but that at the top people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspective is of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
So on that division, then, you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Scholzley with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration, and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on. But it is mostly a supply function.
Spam the like button, guys.
It's mostly a function of the
Hit
change
the share,
in supply.
Repost this stream.
I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. But others argue, as I do, that there is an effect from demand, and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation, because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths, or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. because, you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael Pickey from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand.
I will summarize what happens when he's done
support
talking.
more hiring, and that's why we do it.
I'll give you guys my thoughts on the market.
No 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing and has defied a lot of negative forecasts, continuing to do so this year. Consumers are still spending. Now it may be mostly higher end consumers, or maybe skewed that way, But the consumer is spending, and that's a big, big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But
doesn't reach 7.5
you still got
cents.
the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but They don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
that we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable, those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. All right, Courtney's question, and then I will give you guys.
Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them.
All right. It's time to duel. All right, guys. All right, we just finished up most of the Fed talk from Jerome Powell, and I'm going to give you guys my thoughts. We were watching the 1 minute chart live, and it was a crazy chart. We went from, we started the meeting at about 112,000. We crashed all the way down, got extremely oversold here, all the way down to $109,400 before, guess what, by the end of the meeting, reclaiming the exact same level that we were already at. And what is this? What is this? This is market makers using any excuse that they possibly can to steal liquidity, and that's exactly what happened again. But where are we when you zoom out just a little bit and we can take a look at where is the market? What does this mean? And we'll talk about some of the bombshells that on paper caused the initial crash. Was the bombshell from Jerome Powell where he said that the Fed has not made up their mind in December if they're going to cut or not. And this caused an immediate sharp rejection in the markets before it basically was much ado about nothing, which is what it always happens every single time, by the way. Every single time when we watch the Fed, there's a sharp move up, there's a sharp move down, and then 3 days later, it is a wash, and none of it matters. And guess what will be happening again? 3 days from now, it's going to be a wash, none of it's going to matter, and we'll get the actual trend. And what is the actual trend? Well, here it is. We had a big move all the way down to the double black swan on October 10th. We filled out that lick and wick from that lick. Yeah, the lick is the proper term. The lick that the market makers got their lick in. We filled out that wick, and from that moment, we put in higher highs and higher lows. What I want to see from Bitcoin here is continuing to hold this as a higher low over here. If we do that, get back above the 200 on the 5-hour chart, that puts us back in bullish posture. Now, one thing that's quietly happening while this is happening is Bitcoin Dominance has officially put in a lower low. Okay, this is what we've been waiting for. This is not. This candle was already being very strong before the Fed meeting took place, and this is a strong candle. As we can see, this is like more of a grueling down to this point where this is a big one, and right now we're hanging off on the the 100 moving average, and when you go to one, most likely you fill out the second one, which is all the way down here at a macro lower low. And what we know from Bitcoin dominance is my thesis is that I've been working on. This is Wyckoff distribution. Okay, and this took a long time to play out, and then we had a big crash and a dead cat bounce, and now we are starting to show more weakness again before we get sort of a continuation. So this is a very, very big deal that's taking place right now. And the other two major things that I have my eyes on is gold and the Russell 2000. Now, I've already made my case. On October 16th, I sold 40% of my gold because we were seeing things like this right here. Peak euphoria for gold. Peak absolute pandemonium euphoria for gold. I said on October 16th that I am selling 40% of my gold. We have not been higher for a second. Not a 1 second have we been higher on gold. And in fact, I have been shorting it all the way down very profitably, and I plan to do so very much so. So on the 5 hour, what do we got here? A big rejection here. The most overbought, that gold has been since 1979. And we found a little bit of support off of the 200, bouncing up to the 100, and perhaps getting rejected if we get a lower low again. This is going to plummet when we look on the daily. You can see the moving averages are way spread apart. We're probably going to test the 50 moving average way down here at 3750. The thing is, like, I don't expect gold to have a pin top, blow off top. However, it's so overbought, that wouldn't shock me either. But all we really need is a grueling down and a rotation of capital to continue to play out and to continue to rotate into the Russell 2000 and into Bitcoin. Now, the Russell 2000 holds the key to everything. The gold topping is a major, major, major inflection point. So what do we have here? We had the C19 crash, big spring, and we went into absolute parabolic euphoria. The most overbought that we were was August of 2020. Guess what happened after August of 2020? We crashed back down to the prior range and we just chopped here. And then what happened during that time from April when it bottomed out until November when it absolutely bottomed out? You tell me what happened between April of 2021 and November of 2021. I'll leave it up to you. Well, we had the exact same thing. We had the spring event, which was the April tariffs, which I've said many times is the spring, and gold has went into absolute euphoria. The most overbought that it's been on the monthly chart since 1979. The most overbought has been on the daily chart since August of 2020. Okay, and while this is happening, we have the exact same setup on the Russell 2000. What is the Russell 2000? Why is that important? The Russell 2000 is an indication of risk on assets, okay? Risk on assets. This right here is the April tariff crash. And I've made the case, structurally, this is doing the exact same thing. This is where I pulled this fractal from, what did we just talk about? The C19 crash into the gold top. So what happened here? This is the 2019 into the C19 crash, and then you go into absolute euphoria. What time? March of 2021 was when the Russell 2000 went into distribution. So that was the buying climax. The UTAD for the Russell 2000 was November of 2021. That is textbook Wyckoff distribution. That is literally from the text right here. Here we go. That is the text. Here is the text. So I pulled this fractal from here, and we are outlining it over here one more time. During this time, by the way, that was when things went euphoric. It wasn't until the Russell goes into distribution is when things went euphoric. So I pulled this fractal from here. This is lining up perfectly. Not only is it lining up perfectly, it's literally candle for candle, wick for wick. In fact, we had a major liquidation event during the exact same time. Okay, so when was this? This was October 10th was this major liquidation that took place. It was obviously way heavier in crypto, but it affected the Russell, it affected gold, it affected everything else as well. And if we zoom out, what do we see? Candle for candle. It is following it comically, hilariously. And what we would expect from the Russell 2000 would be another higher high followed by another lower low going into distribution while gold is topping out, while Bitcoin dominance has just put in a lower low. So when you look on the 1 minute time frame, when you look on Bitcoin on the 1 minute time frame, this is really scary when we're watching it live. And I know we live stream it as partly as a dramatic effect, and people start freaking out. People start literally capitulating. I start seeing you guys capitulating live. And then the hilarious thing is, it's all said and done. Guess what? The market makers have done their thing. They've grabbed their liquidity, and we're literally back at the same level since before we started. So what I want to see from Bitcoin on a serious note, on a higher time frame, I want to see the higher low hold. And where we wicked all the way back down, guess where we wicked back down to, ladies and gentlemen, on the daily chart? The same thing that's been support since 2023. What is that? The 200 moving average over here. All the way back since 2023, we can see this dark blue line since March 10th of 2023. When Silicon Valley Bank went to zero, this dark blue line, which is the 200 EMA, has been support for Bitcoin. Every time we get there, it's scary. And then what happens? What just happened today, even with the Fed talking, we wicked perfectly to it and found it as support again. So what do I want to see? I want to see the 200 hold. I want to see a higher low be confirmed. I don't want to see, I'm going to start being concerned if we take out this low over here, 105, and I will definitely be concerned if we take out 103. If we take out 103, then, that would be more in line with a dead cat bounce and then putting in a lower low. That would make me concerned. But as it stands right now, we're on top of the 200. We're in bullish posture. The market makers have grabbed liquidity, which they always do. And another rule that I'm going to add to the trading challenge is don't trade the Fed. It's not a good idea. I knew it's not a good idea, but I still did it anyways. But that's beside the point. It's not a good idea to trade during the Fed because there's extra heightened volatility. And then when it's all said and done, 3 days later, it's much ado about nothing, and you get your actual trend. So what do I expect? I expect Bitcoin to find support off the 200. I expect gold to continue to roll its way over. I expect the Russell 2000 to continue to follow the same exact structure, and we'll see where that lands us. I am cautiously optimistic right now, and I think that Bitcoin in the short term, medium term, is going to get back to the top of the range, and we'll see what that does with Bitcoin dominance. We'll see what that does with the Russell. We'll see what that does with Bitcoin and the altcoins. But that is going to be it for this time. Make sure you guys like, subscribe, follow me on TikTok, YouTube, Instagram, Twitter, Twitch. I will never message you first. Peace, love, prosperity. God first, God bless. All right. I just recorded a video. I'll answer some questions for like 10 minutes. That video will be up on YouTube here shortly. But I'll answer some questions here for a bit before I hop off here. Does that wick on Bitcoin dominance count for a lower low? I think so because, okay, that's a good question. That's a good question. So if we look on like the daily for Bitcoin, I would count this wick as a back test of the 200, right? If you look on the 5 hour for Bitcoin, we can see like Bitcoin looks way stronger, right? But when we look on Bitcoin dominance, though, this candle is strong. This isn't just a wick. Like, did the wick take it out? Yes, it did. But look at the body of this candle. This is a strong, strong candle. Like, look at the difference of this candle right here on Bitcoin dominance versus this one over here. This has way more strength. This has way more strength. Like, it's not even close at this point. Sorry, TikTok's making me. So, yeah, I would say so. Yeah, a lot of times I don't, I'm very cautious about counting wicks, but look at the body of this. I think that we're going to test the 200 down here at 59.2. Total 3 still holding bullish. Yeah, listen, guys. I just let you guys come on here. I didn't say much. I let Jerome Powell say his thing. I let the markets do their thing. I am slow to come out here definitively because I want to be more right than I'm not. And, what I always know to be true is during the Fed, there's lots of moves. But it's much ado about nothing. It's lots of moves up, lots of move down, and then by the time it's said and done a week later, nothing happened. really, other than people got liquidated, myself included. I didn't get liquidated. I got my stop loss hit. I had a stop loss long on Bitcoin at 10.5 or 10.8, and that got hit. They did lower rates 25 basis points. The big thing was that he put out that it wasn't definitive, and that's what the reason. That's the esoteric reason. That it was not definitive in December if they're going to cut rates or not, and the markets pretty much already have priced in that they are. So that was a shock when he said that. But again, to me, it's just market makers just giving an excuse to grab liquidity. It's like, anyways. So there you go. That is, can't hear you if you talk away from the mic. Was a crypto beard bet line. The beard bet is still the same. It is Solnic to 7.5 cents, or I will shave my beard. That is the bet. That's what he always says. I know, right? I know. But, people still get capitulated. I move my slop loss. Did anyone else? That is a dangerous game. That's a sinful game. And listen, you pay your sins now, okay? When you move your stop loss, you are sinning. And the thing is, you will get away with it one time. You will get away with it 2 times, 3 times, 4 times, 10 times, 20 times. You will get away with it. You will get away with it. You will get away with it. And then one time you won't get away with it. And then you have to pay for your sins. And the more sin you get away with, the greater the penalty. So, listen. Don't do it again. I'm glad you got away with it. I'm glad you got away with it. But listen, be careful. Alt season delayed. When did you hear those words come out of my mouth? What I said was Russell is following perfectly what it did in 2021. Gold is following perfectly what it did. Everything, yeah, those words did not come out of my mouth. His V chain bet, 10 cents. Is there any scenario where we actually get an alt season this year? Yes, listen. All we need to do is continue the path. That's it. That is it. If the Russell continues to follow this, which has been following perfectly, that's all we need to do. That's it. If gold continues to crash, I believe gold has topped. I have been shorting gold. I sold 40% of my gold. Gold has topped. If that holds to be true and the Russell continues to follow what it's been following, that's what we're going to get. No one will believe it until it's already over. So that's the deal. Maybe I'm hearing things I want to hear. Maybe. Maybe so. Like the idea of the cycle, to me, the cycle is definitely different, but it's also the same, right? So how is it different? It's different because institutions are involved. It's different because, so many people there have been things that have been delayed, and, we're definitely not on the 4-year time frame anymore. Like, all of those things are true, but it's the same in that gold topped first, the Russell was breaking out, Bitcoin was breaking out. Bitcoin dominance started to roll over. All of those fundamental things are the same, and all of those fundamental things, we have the same setup. Stop having jam on your toast. Listen, my man Jams has been bearish since 2022. Like, a broken clock is right twice a day. That's it. Like, I have video evidence. I have video evidence that he's been bearish consecutively since 2022. Consecutively. So, listen, I have nothing but love for everyone in my heart. I don't wish anyone ill will or anything like that. But
there is a
factually, consecutively, my man has been bearish since 2022. Consecutively. All right, so I wish him well. A broken clock is right twice a day. Mr. Anderson, thanks for becoming a member for 11 months. You savage.
But the cream will rise to the top. Oh, yeah.
Hey, Ski, I joined YouTube membership. Was curious to get into the Discord, Telegram. Could I DM you? Yeah, send me a DM. Generally, though, the Telegram is for people who do the consultation. I've been putting out my trades on the YouTube membership, so you should still see it. If I put out a trade, it will be. I'll put it out on the post for TikTok. I started doing this on TikTok and YouTube as well, where it'll show my trade, it'll show my stop loss, my entry, or my limit entry, and then my 4 take profits. Ski, do you like? Sui, I don't. No, Siri, go away. But the Telegram is for people who do buy 2 NFTs from hedge funds or book a consultation. But you should still be able to get the same trades if that's what you're looking for. Member for 11 months. The cream rises to the top. It's worth the wait on my mama. That's right. Is XRP your biggest alt bag? XRP is my biggest alt bag. I try to rage bait Jam on his live. I feel like y'all try to rage bait me sometimes. I'm hard to rage bait. I'm like super. Have you ever guys seen me get like mad? I'm pretty even keel. I think that's why y'all show up for me. I don't like Sui. No. Pulling up receipts. Listen. It's fine. If you want, listen, I get it. Like, people have like a savior complex. In that they want to have like a savior. It's like it's in our DNA to have somebody that we want to save us. Right? My thing is, like, I want you to be your own hero. I don't want to be anyone's savior. I am not the Messiah, okay? If you look to me as the answer, then you will go to hell. Right? I put on pants one leg at a time just like everybody else. I don't want to be anybody's hero. I want to teach you how to fish. I don't want to fish for you. Okay? That's my goal, is to liberate you by waking you up. Wake up! It's not to be anyone's savior, or I'm the Messiah, or I know all, tell all, see all for the right price. None of that. Okay? So I get it. Like, people have a savior complex where they want someone to save them. And they'll see somebody call things 2 or 3 times in a row, and next thing you know, it's like, oh, this is the new guy. He got it right twice. He picked the lucky number 11 2 times in a row. He's the new savior. I get that. So I'm just trying to show you that, like, hey, your savior, it's easy to pick lucky number 11 if you pick lucky number 11 every single time. Voice on YouTube is very low. Test. Shouldn't be. I'm going to hell. Knock, knock, Neo. Yeah, that's right. I'm Morpheus, guys. I'm not Neo. I'm Morpheus. I'm giving y'all the pill. We rage bait. Stop masturbating, everyone. All right? My God. The master rage baiter. Follow the rabbit. Oh, it is low. What is going on? Hold up. There we go. I don't know what happened there. That's okay. I was about to end it anyways. But ski. All right, guys. That is going to be it for this time. I appreciate each and every one of you guys. Make sure you guys like, subscribe, follow me on TikTok, YouTube, Instagram, Twitter, Twitch. I will never message you first. Do not redeem. Why are you redeeming it? No!